Hello and welcome to episode 18 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Surya and I'm coming to you from the San Francisco Bay Area.
And my name is Tamanna Surya, and I currently attend the University of California, Los Angeles.
After having our first guest on this podcast last week, we get back to regular programming from this week. On this podcast, we will discuss a big spike in M&A activity, including a nearly $11 billion deal for Skechers by 3G Capital, large buybacks by GoDaddy, and the dental aligners company Align Technology, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided on this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
If you have been enjoying this podcast, do us a huge favor and take a moment to like, subscribe, or rate this podcast on whatever platform you may be listening on. It will prove to be useful fodder for the algorithmic gods. So let's get this thing started with announced M&A activity. We'll be covering special situations activity that happened over the past 2 weeks to make up for any key events that we missed last week when we had Chris Timo Jr. on as a guest. Let's begin our M&A section with a look at updates to ongoing mergers and acquisitions.
The Beacon and QXO deal, an acquisition that we've been tracking since almost the very start of this podcast, finally closed on April 29th. Beacon Roofing Supply was acquired for $124.35 per share, valuing the transaction at approximately $11 billion. Approximately 44 million shares, representing about 72% of all issued and outstanding shares, had been tendered as part of the tender offer that QXO had launched, and the remaining outstanding shares were acquired via second step merger. I still think it's pretty hilarious that the whole saga ended in a share price that was just 10 cents above the original share price that QXO offered, but I guess that's merger arbitrage for you.
Yeah, the management team held out. They didn't want to meet Brad Jacobs. And then in the end, they're like, yep, 10 cents more, that seals the deal for us.
Yep.
I think they had to extend the tender offer a few times, and I'm glad they finally got it all done. Speaking of amending deal prices, we typically see amendments to increase the deal price for a merger or acquisition, but there's an interesting situation that's been developing over the last few months where the deal price was lowered instead of raised.
Akoya Biosciences was set to be acquired by the life sciences company Quanterix Corporation in a tiny deal. Akoya Biosciences' market cap is just $54 million. We normally wouldn't discuss such a small deal, but the activist Kent Lake Partners, who owned a roughly 6% stake in Quanterix, got involved in the deal to argue that the acquisition was not in the best interest of Quanterix shareholders. We normally see activists getting involved in an attempt to bump up the deal price, so it's quite interesting to see the opposite happen here.
The spread on this deal had hit highs of over 60% as the market correctly anticipated that the deal was at risk. And until earlier last week, when Quanterix and Akoya Biosciences announced an amendment to the terms of the merger agreement, the spread had remained high. Originally, the deal was an all-stock deal that was valued at $3.73 per share. Under the amended terms, though, each Akoya shareholder will receive 38 cents per share in cash and then 0.1461 shares of Quanterix common stock, representing a total value of just $1.22 per share.
As expected, the spread on the deal dropped quite sharply, and hopefully Kent Lake Partners and another major shareholder of Quanterix, Tikva Management, who also voiced opposition to the deal, are satisfied.
We saw a big spike in M&A activity over the last week. 6 new deals were announced, including 3 that were over $1 billion in size, and one of those 3 was over $10 billion in size. We wanted to briefly cover the largest deal from the prior week, which was Merck acquiring SpringWorks for $3.4 billion in cash or $47 per share. It is worth pointing out that this is the German Merck and not the American pharmaceutical giant, which also has the same name of Merck. The premium paid for this all-cash deal was just 5%.
The premium on this deal was quite unusually low, largely due to the fact that rumors arose in February that Merck was interested in buying SpringWorks, and the stock jumped from around $40 per share to $54 per share after those rumors surfaced. The fact that the final deal price was just $47 points to some of the risks associated with getting involved in rumored deals or pre-deal situations.
Clearly, a lot of optimism that this was going to be a much larger deal than it turned out to be. Speaking of large deals, we saw one of the largest ones last week when Skechers, the famous shoe company that is known more for their comfortable shoes that lend themselves to being worn all day long instead of setting any fashion trends, will be taken private by the Brazilian PE firm 3G Capital.
Skechers shareholders can choose to receive either $63 per share in cash or $57 per share in cash and 1 share of the new private LLC. The structure of this deal is highly unusual, where a portion of the payout will be in this newly formed privately held company, which will participate in the future growth of Skechers. The mixed consideration, where you get both cash and units in the privately held company, is limited to 20% of total outstanding shares of Skechers. If you don't make an election, you will automatically just get cash.
I've held Skechers shares for a few years and actually don't mind wearing their shoes as well, despite the lack of fashion statement they make. And the investment has actually worked out well for me. And I don't really mind 3G taking the shares off my hands, especially in an uncertain world where tariffs could significantly impact the cost of goods and margins. 3G Capital is a Brazilian investment firm that is known for its significant cost cutting and bringing operational efficiencies to the companies it acquires. One of 3G's 3 co-founders, Jorge Paulo Lehmann, was a personal friend of Warren Buffett. 3G had actually teamed up with Berkshire Hathaway in 2013 to take Heinz, the ketchup company, private in a $23 billion deal. And in 2015, they merged Heinz into Kraft Foods.
The combined company, Kraft Heinz, is down more than 60% over the last 10 years, so this wasn't exactly the home run both 3G and Berkshire Hathaway were expecting. The returns don't include dividends, and the company's current dividend yield is 5.6%. 3G exited their stake in 2022, and Buffett admitted that they had overpaid for Kraft Heinz. Hopefully, 3G's outcome with Skechers will be different.
Yeah, I wonder if those issues were unique to those food businesses because, as you know, Heinz ketchup and Kraft mac and cheese, these are household names. But over the last several years, private label has been taking a lot of the market share away from branded company foods. And at the same time, if these large companies are not able to use, uni-channel, such as a TV that everybody used to watch to advertise their products, it becomes that much harder for them to capture consumer share, if you will.
Yeah, we kept seeing insider purchases this week at various food brands companies, and I remember each time you always said you never liked the food packaged products anyway. So
yeah, it's been an industry that's been best to avoid for the better part of the last decade, and you saw this with Kraft Heinz. Switching gears a little bit to spin-offs, news leaked recently that Sony Group is considering a spin-off of its semiconductor business, which would mean Sony Semiconductor Solutions would become an independent entity with the parent company retaining a minority stake in the business. Sony's semiconductor business has plateaued in recent years, and the recent tariff situation also poses quite a threat. The business is currently attempting to deal with higher costs, shrinking margins, and competition from Chinese chip makers which means this is in some sense Sony getting rid of an underperforming division, and something I think Dan Loeb had asked them to do for several years, but they did not execute on.
Nice to see that they're finally planning on executing now, then. Moving on, we don't normally talk about bankruptcies on this podcast, but Weight Watchers recently announced that it was filing for Chapter 11 bankruptcy, mostly in order to deal with the $1.5 billion in debt the company has been grappling with. The business expects to emerge in roughly 40 days as a publicly traded company, but quite frankly, I think anyone could have seen the business was struggling, especially with drugs like Ozempic and other GLP-1 medicines on the market.
Yeah, I remember back when Oprah Winfrey had gotten involved with this company, I was kicking myself for having missed the essentially meteoric rise in the stock after she got involved. Coming back to what's happening now, the company lost its CEO, Seema Sistani, in September 2024 after 2 years in her position. She was supposed to engineer a turnaround, which, given the company's poor financials, clearly hasn't happened. The company lost its CEO, Seema Sistani, in September 2024 after 2 years in her position. She was supposed to engineer a turnaround, which, given the company's poor financials, clearly hasn't happened. And as I like to always say, turnarounds rarely turn around. Weight Watchers also lost its star board member, Oprah Winfrey, in February 2024. The company is down almost 80% in the last year. And I'm curious to see how everything will play out going forward once it re-emerges from bankruptcy.
Absolutely. Switching gears once again to buybacks, GoDaddy just announced a $3 billion buyback representing over 11% of the market cap at announcement.
I think I've paid so much money to GoDaddy over the last 2 decades for domain registration fees on various domains that just caught my attention or fancy, that it is possible that 1 billion out of those 3 billion they're allocating to this buyback came directly from my pocket. All right, I say that just in jest, but yes, it is very much the domain registrar of choice with everyone that I speak to. I looked at their buyback activity, and this is one of those companies that not just talks the talk, but also walks the walk. And they've retired more than 16% of their shares outstanding over the last 4 years.
Looking at the company, revenue growth has slowed down to the high single digits, and the reason that it is trading at over 30 times forward earnings is because free cash flow has been growing consistently, margins are high, and there's only $3 billion of net debt on the balance sheet.
Yeah, that $3 billion of net debt might look large to someone, but then once again, the market cap is $29 billion. So in that context, it's not that big. We also saw another potential double dipper buyback this week. This is a situation where companies repurchase their own shares while insiders are simultaneously buying stock on the open market. Select Medical Holdings, an operator of hospitals and healthcare centers, recently announced a $1 billion buyback, representing, get this, nearly 43% of the company's market cap. We review all special situations activity all day, every single night, and starting with insider purchases. So when we heard about this buyback, it was quite amusing since we had just seen an insider purchase at the company by director Parvinderjit Kanuja, who purchased $315,000 worth of stock last week, I think.
Right. Moving on to yet another buyback, this was a very heavy buyback week. Align Technology announced a new $1 billion stock repurchase program that amounted to nearly 8% of the company's market cap at announcement. Just like GoDaddy, Align has also been buying back its stock, but it's only retired about 6% of its shares outstanding over the last 4 years. We have covered Align a few times on Inside Arbitrage because of its well-timed insider buying by its CEO, but it seems as if that trend no longer is the case. The stock has been on a roller coaster over the last few years and is down about 35% in the last year alone.
We should probably mention what Align Technology does. This isn't a software company. As you know, they make a popular Invisalign line of dental aligners. And for a long time, children and especially adults preferred Invisalign to the old metal braces. However, I was a little surprised to hear on the radio a few days ago that kids these days seem to prefer the metal braces, and those are the in thing these days. This seemed so surprising that when I went to my dentist a few days ago, I asked them about it, and one of the dental hygienists confirmed that this was indeed the new trend among kids. Unless it is a passing fad, this is not good for aligned technology, even though parents of kids are probably very happy paying less for those perfect looking pearly whites.
Coming back to Align Technologies as a company and its financials, you can see the trend in the business's revenue growth, which has dropped to the low single digits in the last 3 quarters, and Q1 2025 earnings were a penny per share below the Q1 2024 earnings. Unlike GoDaddy, free cash flow in this case appears to be headed in the wrong direction. The company has $800 million of net cash on the balance sheet, and having the buyback authorization in place in case the stock gets cheaper is not a bad idea.
The third large buyback that is worth mentioning is one that just came in right before we recorded this podcast, and it's by the ride hailing company Lyft, which reported strong results with net revenue growing 14% in Q2 to $1.45 billion and generating nearly $1 billion in free cash flow for the trailing 12 months.
This gave the company confidence to supersize its stock buyback program to $750 million from the prior $500 million authorization put into place in February of this year. And we actually talked about that in one of our earlier podcast episodes. This $750 million authorization represents nearly 14% of the company's market cap. They plan to accelerate a big portion of this authorization by buying back $500 million within the next 12 months, and $200 million of that will be repurchased in the next 3 months.
That is a very good sign when they decide to accelerate the repurchase, because as we've mentioned many times before, companies announce buybacks and then it plays out over many years, or in some cases never happens. We covered Lyft in a monthly Buyback Wednesdays article in March after its initial $250 million buyback authorization. And I mentioned in that article that I was embarrassed to admit that I've never downloaded the Lyft app. That changed in a hurry during a trip to Omaha a few days ago, where given the demand for Uber, I downloaded the Lyft app and we exclusively used Lyft during the trip with a very good experience. Overall, it seemed to cost less than Uber and we found our rides much faster than we were seeing on Uber. Speaking of Berkshire, while waiting at the exhibition hall there, a friend of mine brought up the company Turtle Beach, something that he had invested in and done well with during the pandemic. Turtle Beach is an audio technology company that makes gaming headset solutions for all sorts of consoles and devices.
Yeah, I pretty much recognize the company because we always used to see insiders buy shares about a year or so ago, and I thought it was so uniquely named.
Yeah, especially I think the stock symbol is HEAR here. Anyways, Turtle Beach was brought up as an example of companies that may not be a very good investment at the company level, but a good investment in specific kinds of markets. During the COVID-19 pandemic, when everyone was at home and ready to game, Turtle Beach absolutely thrived and the stock ran up like crazy.
But once things returned to normalcy, so did Turtle Beach. The company has not been performing well. The stock is down about 33% in the last year, and the company has been struggling with profitability to some extent. The company also has around $105 million of debt compared to a market cap of $198 million, which makes the recent $75 million announced buyback all the more peculiar.
The buyback represented nearly 38% of Turtle Beach's market cap at announcement, but given how the company is struggling, there may be a better use of capital. I think this is a pretty good example of how buybacks aren't always a positive signal and can be a waste of capital for certain companies.
Moving on to insider transactions, one of the things that we see quite frequently when it comes to insider sales is Joseph GGaA, one of the co-founders of Airbnb, selling shares of the company. GGaA left Airbnb in 2022, but remains on the board of directors. It's probably for the best that he has been a constant seller of Airbnb, because the stock really has gone nowhere since going public in December 2020.
They had priced their IPO at $68 per share, but it closed its first day of trading at more than double that price, at almost $145 per share, and the stock now trades at just $127. I've sold cash secured put options on the company for a healthy premium a few times, but I've never directly purchased the shares.
This week, it was surprising to see KGaA, who's also on the board of Tesla, buy 4,000 shares of Tesla for a little over $1 million. He paid an average price of $256 and change, and the stock is already up 16% since his purchase 2 weeks ago. The buying is also interesting because there were rumors that Tesla's board of directors had reached out to search firms to look for a potential successor to Elon Musk, which is something that the board and Elon both denied.
Yeah, Tesla is a company that is clearly in flux, both in terms of competition from other companies, including the Chinese EV company BYD, and the big drop in popularity for Tesla in Europe. We often see stickers on Teslas in California claiming that the car was purchased before Elon went crazy. I sometimes wonder if all of this is a part of Elon's diabolical plan to first capture the left with his climate change messages and now attempting to capture the market on the right by aligning himself with Trump. At any rate, the only insider buying we have seen at Tesla that was over $1 million in size was by Elon himself, and usually only when he was participating in a secondary offering by the company.
We've been talking about the biopharmaceutical company Alumis quite frequently in the context of this podcast in prior episodes, but often in relation to their ongoing attempt to acquire Acelyrin and the negative spread on that deal. But the last I checked today, actually, when we're recording this podcast on Friday, May 9th, the spread on the deal is now a positive 2%. So that's an interesting development for sure.
What was also interesting was that we saw a director of Alumis purchase shares of the company. Insider buying during an active mergers situation is rare, but we tend to see it more in the parent rather than the target company, as is often the case, and as is the case with Alumis. Perhaps the director believes that the acquisition will add plenty of value for Alumis, or is simply reacting to the sharp drop in the company's stock price over the past couple of weeks.
Moving on to yet another set of insider transactions, I was quite surprised to see 5 different insiders of Organon purchase shares this week. I actually recognize the company since it's one of the few pure-play women's health companies and was spun out of Merck in June 2021, so I've kept up my eye on it from time to time. As is the case with many spin-offs, Organon has a pretty massive debt balance, around $9 billion against a market cap of $2.4 billion. Despite this massive debt balance and the equally massive interest expense that the company incurs, over $500 million in 2024, the company has still managed to generate some pretty solid net income and consistently grow revenue over the last couple years, though that trend may seem to be reversing.
The company appears to be quite cheap and it's trading at just a little over 3 times earnings. But once you include the debt and you use a number like EV by EBITDA or EV by free cash flow, which is my favorite metric, it's not quite as cheap. That being said, Organon's stock price has dropped by over 30% in the last month, which was at least partly due to Q1 2025 results, which are released on May 1st. Revenue and net income were both down year over year. With this announcement, the company has also cut the dividend down from 28 cents per quarter to just 2 cents per quarter, a nearly 90% drop in the dividend. While this might be a good move from the management's perspective, dividend investors were clearly not happy, and as they exited the door, the stock dropped sharply.
Moving on to our last insider purchase for the week, we were quite happy to see continued insider buying at our favorite hotel REIT, Pebblebrook Hotel Trust. Chairman and CEO John Bortz bought a little over $500,000 worth of Pebblebrook stock as per usual, and we actually also saw another insider, Director Michael Schall, purchase shares. It was this purchase by Mr. Schall that actually caught our attention, especially considering that, save for a purchase in March of this year, this was the first time Mr. Schall had bought shares of Pebblebrook since 2011.
Mr. Schall has quite the background. He was the president and CEO of the apartment REIT Essex Property Trust from 2010 to March 2023, after which he retired from the company. He has been with Essex since 1993 as a company's CFO and played a key role in taking Essex public. As we know, Essex Property Trust is one of the largest apartment REITs out there, up there along with Avalon Bay.
Absolutely. And we always love to see insider buying from independent directors with industry experience, which is exactly what Mr. Shaw represents. Pebblebrook stock is down about 30% in the last year, so perhaps Mr. Shaw is seeing this as the perfect opportunity to buy.
Yeah, that makes a lot of sense. I bought the stocks. It usually goes down 10 to 30% before eventually, hopefully, going up again. And we've discussed Pebblebrook on other podcasts as well. Switching gears once again to activists this time, Bill Ackman's new offer for Howard Hughes involved him paying $100 per share to invest $900 million into the company, but still limiting his voting power to just 40%, even though he would own 47% of Howard Hughes after this investment. The company would convert to a diversified holding company, and they mentioned getting into the insurance business, much like Berkshire Hathaway, in order to allow Pershing Square to manage the insurance equity portfolio. I wonder if Bill Ackman and Pershing Square will charge a separate fee to manage the insurance related equity portfolio.
Perhaps. But the biggest sticking point for most Howard Hughes investors is the 1.5% management fee Pershing Square plans to charge based on Howard Hughes' market cap. It is set up as a quarterly base fee of $3.75 million and then the 1.5% annualized fee. It is super important to mention that this management fee only applies to the increase in market above a reference market cap.
That was interesting. Until I read it closely, I didn't realize that he only wanted to charge the 1.5% management fee above that reference market cap. Everybody assumed that he was going to charge the 1.5% fee on the full market cap. So that makes it a little bit more palatable, if you will, than what we had assumed before. So in the press release, they mentioned that the reference market cap is determined by multiplying the post-transaction share count of 59.4 million by the reference market price of $66 and change, which is adjusted annually for inflation and a few other things. My initial reaction was that this was not the best deal for Howard Hughes shareholders, but the fact that he's paying a 48% premium for the $900 million investment is actually quite fascinating, even though somebody like Warren Buffett or Charlie Munger would never dream up such an incentive fee.
It is also worth noting that Howard Hughes reported fiscal Q3 earnings result last week, with revenue growing 43% to $327 million and GAAP earnings per share of $1.95 per share. Clearly, the separation of Seaport Entertainment is helping their bottom line, as that was a cash incinerating business for them.
Coming to the final part of this podcast, which is C-suite transitions. When it comes to management transitions, the biggest announcement of the year or even this decade was something both of us witnessed firsthand in Omaha a few days ago, and we live tweeted the news as it happened. By now, you've heard that Warren Buffett's decision to hand over the CEO role to Greg Abel and transition to the role of chairman of Berkshire Hathaway. When I got back from attending the Berkshire Hathaway meeting last year, I mentioned in an article called Reading Between the Lines that Buffett and Munger picked Greg Abel as their successor to manage Berkshire's fully operating businesses like BNSF Railway, Pilot Travel Centers, Seas Candies, etc. And they picked Ajit Jain to run their insurance operations like Geico.
They had also picked Todd Combs and Ted Weschler to manage portions of Berkshire's money allocated to public equities. The magic of Berkshire happened when the operating subsidiaries sent the extra cash generated from their business back to the parent company for Buffett and Munger to reinvest in new opportunities.
When Buffett was asked who would be responsible for these kinds of capital allocation decisions going forward, many of us in the audience last year were surprised to hear Buffett indicate that it would be Greg Abel instead of Todd and Ted. Reading between the lines, it became clear that Todd and Ted's stars had dimmed within the organization. After I returned from that trip, Buffett revealed that he was considering having Greg Abel manage decisions about the public equities part of their portfolio as well.
Taking it one step further this year, Buffett entirely handed over the reins of Berkshire to Greg Abel, which once again was absolutely fascinating to see live.
I wrote an article called The End of Berkshire as We Know It last week and mentioned in that article that one of the conclusions from William Thorndike's brilliant book, The Outsiders, was that some of the best performing companies had a CEO that was an excellent capital allocator, and that CEO could rely on an outstanding chief operating officer to run the business for them. To expect Greg Abel to do both is a very tall order.
Moving on to our last C-suite transition before we wrap up this podcast, we typically discuss C-suite transitions at public companies and don't really focus on C-suite transitions at private companies. But there was a really fascinating saga that developed this week that resulted in a sudden CEO resignation and departure at a private company, which ended up affecting the public company Compass Diversified, otherwise known as CODI, which is why we felt it was worth discussing.
CODI is a holding company that acquires and actively manages middle market businesses. So something like AKYA that we've spoken about before, or IAC in some sense. And we've actually written about the company in the past. Key CODI holdings include Velocity Outdoor, Primaloft, and Honeypot. But one of CODI's largest holdings is the luxury jeweler Lugano. And Lugano is what caused CODI's stock to drop by a whopping 60% in a single day last week.
Earlier this week, CODI disclosed non-reliance on its financial statements for fiscal 2024 amid an ongoing internal investigation into their Lugano subsidiary. The company also decided to delay the filing of its first quarter 2025 Form 10Q. The investigation was launched due to concerns of how Lugano was potentially financing inventory and led to irregularities being identified in Lugano's non-CODI financing, accounting, and inventory practices. This ultimately resulted in the board concluding that CODI's previously issued financial statements for 2024 should require reinstatement and should no longer be relied upon. So essentially, the numbers can no longer be trusted.
CODI owns a 60% stake in Lugano, and the subsidiary's founder and CEO, Moti Ferder, resigned from all of his positions at Lugano with no severance compensation. A few days later, the law firm Levi and Korsinski was exploring suing CODI for securities fraud violations, as you often tend to see in these cases. And another firm announced a lawsuit against CODI and several senior executives for potential violations of federal securities laws.
Remember our disclaimer at the start, we're by no means legal experts, but this doesn't bode all that well for CODI. Certainly a fascinating situation from start to finish though, and it reminds me a lot of the Macy accounting mishap from last December, but to an even greater extent, where the fiscal 2024 results can't be trusted at all. I personally have never seen anything like this before in the short time that I've been investing, so I'm curious to see what this means for CODI going forward.
I took a quick look at CODI's financials and what portion of their profits were driven by Lugano, and it's actually quite large. So doing some back of the envelope math, it sounds like if the Lugano profits go away, CODI might actually have no profits at all. Don't hold me to that, but that just goes to say how significant this issue turned out to be for the company.
And that wraps up episode 18 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
And if you've gotten this far into the podcast and enjoyed it, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.